Well, thank you very much for tuning into our webinar today, and really appreciate everybody joining us. We're really excited. My name is Grant White with Endeavor Wealth Management. Also on the line, we've got Brant Butt with Endeavor Wealth Management as well. And we're really excited to have a guest speaker today, JP Laporte with Integris, joining us, and he's going to walk us through a case study about the personal pension plan, or PPPs. This is something that a tool, a strategy that we've found incredibly useful for a number of our incorporated professional clients and business owners. And so we're excited to share with you more details today about it, and be happy to answer any questions you have as well afterwards. So with that, I'm going to pass it over to JP, and JP, thanks again for joining us today.
Oh, thanks a lot, Grant, and welcome everyone. So today we are going to be speaking about the personal pension plan in the context of a case study. We've decided that we would tell the story through an actual case of a medical doctor who's contemplating planning for retirement. But before we even get to the case study, we always like to start by asking three fundamental questions. And the questions are as follows. Do I want to pay less tax than 98% of Canadians who are using other forms of retirement savings plan? Do I want to maximize my retirement income? For the same amount of risk, do I want to end up with more money at the end? And finally, do I want the tax refunds that are generated by using pension plans to pay for the cost of the program instead of that cost having to come out of my own pocket? And for most people, the answer to these three questions is yes. So let's proceed on that basis. But before we even get to the case study, what is a personal pension plan, a PPP? Well, the legal answer is that it's a combination, a registered pension plan. So it's a registered pension. And think of some of the large pension plans in the country, like the Teachers Pension Plan of Ontario. So it's governed by Section 147.1 of the Income Tax Act as a registered pension plan, and it combines three separate components. So there are three accounts under one roof. We have a defined benefit account or component, we have a defined contribution account or component, and an additional voluntary contributions account. And the elegance or the beauty of the PPP is that it has flexibility, it allows you to flip between these components every year, depending on a host of situations. For example, if you have a lot of cash flow in your company and you're trying to claim as many tax deductions as possible, typically you'd be using the defined benefit component. But if cash flow tightens up and you want to reduce the contributions, we have the ability to flip into defined contribution mode. And there, the law only requires the company to contribute 1% of salary, or T for income. There's a companion account, the additional voluntary contribution account, that allows you to put anywhere between 0 and 17% of your salary, or T for income, as a voluntary employee contribution. Of course, that gives you a personal tax deduction. So it's kind of like contributing to an RRSP. The ABC account also allows you to transfer existing RSPs you might have elsewhere into this component of the plan on a tax-deferred basis, so there's no tax. And now, once the assets are inside this yellow ABC account, all the investment management fees become tax deductible to the business, which they were not when the money was sitting in an RRSP. And they also become creditor protected. And there's a whole bunch of other positive consequences to transferring the money in there. So that's the basic architecture of the PPP. Three components under one roof, registered with CRA. And the reason why it's important to structure a pension plan in this way is because what we've done is we've put everything under one roof, and all the advantages are now acting in our interest. So what it means from a mathematical perspective is that because we're allowed to contribute more than any other type of tax sheltered account, like the tax-free savings account, the RRSP, and even the individual pension plan or IPP, if the internal rate of return on assets is identical, depending on regardless of the type of plan you're investing in, mathematically over time, you'll end up with more money in retirement. So that's why we're so proud of the PPP, because for the same level of risk, we can make sure our clients maximize their retirement savings over time, which was the second question that we asked at the very beginning of the presentation. So finally, the case study. And the reason why we do a case study is because there are so many moving parts with a personal pension plan that is kind of overwhelming to just talk about them in isolation. So in order for our partners and their professionals and for the clients to better understand all of the advantages, it's better if it's recounted in the form of a case study. So we have a 45-year-old medical doctor that is happy or has experienced in the past a 5% rate of return on their investments. So not a super risk-prone individual. The medical professional corporation that was incorporated back in 2010 by this doctor has been paying a salary, T4 income of $150,000 since 2010. He has been able to stash away in their RRSP $450,000 to this point in time. And while he's 45, he'd like to retire 20 years from now at 65. Of course, this is arbitrary. He could retire before, he could retire after, but we just picked 65 for ease of calculation. And the corporation is paying corporate tax at 15%. Of course, in some provinces it's lower right now, in others it's higher. But we think that with the COVID government measures, the government will have no choice but to increase the taxation on corporations. So even companies that are benefiting from the small business deduction may see an increase in their corporate tax rate over time. So let's cut to the chase. Let's get to the result right away. And the first question people always ask me is, well, you know, I can put a lot of money in my RSP. I can max out my RSP every year. How much more am I allowed to put in a PPP above and beyond what I'm already allowed to do with the RRSP? And the answer for this doctor is $484,000 more and change. So that's not too shabby. That's almost $500,000 of additional tax assistance that we're providing this doctor, above and beyond what he could have earned or enjoyed using an RSP. So the question then is, well, if I'm allowed to put almost $500,000 more and it's growing at 5%, how much more gravy, how much more capital will I have by the time I retire at age 65? And the answer for this doctor is $779,000 of additional registered assets above and beyond what he could have accumulated had he maxed out his RRSP every year. So again, that's over $750,000 more money for no extra market risk, because whether this individual is using an RRSP or a PPP, we've assumed that the assets are growing at 5%. So the next question we get is, well, that doesn't seem too fair. Why is it that you in a PPP get an extra $484,000 to shelter and I'm stuck with the RSP limit? Well, the answer is pension legislation is more generous than RSP rules. And it breaks down into 4 different categories. So for example, I told you when I was relating the assumptions that this doctor incorporated in 2010, so 10 years ago. So we have 10 years of past service that we can purchase under the pension plan, which will create a corporate tax deduction, in his case, of $52,358. So that's extra corporate monies, pre-tax dollars that are going into the plan to satisfy the purchase of past service requirement. Now, on an annual basis, because pension laws are more generous than RSP rules, we can always put more money than the RSP limit. So if you add all of these extra pieces of contributions that the pension laws permit, and you total them up over the 20-year period, we're looking at over $315,000 of extra contributions. Remember the yellow ABC account, which allows for personal contributions? Well, in his case, over that 20-year period, he's allowed to put almost $19,000 of extra personal tax deductions in that ABC account. And finally, I told you that he was happy with a 5% rate of return, whether it's in an RSP or in a PPP. Well, 5% is not as high as 7.5%. And 7.5% is the government mandated hurdle rate that you need to earn within a pension plan in order to maintain what we call full funding. Full funding meaning that we don't have to make any extra contributions to keep the plan funded. So in his case, because of the 5% assumption, it means the corporation can now shelter almost another $100,000 through what we call special payments. So that's how we derive this $484,000. So we could probably end the presentation here if we wanted to and say, well, you know what? You've given me almost $500,000 more tax deductions, plus I'm going to enjoy $750,000 more in retirement with no extra risk. I think I'm ready to sign up. But actually, there's 3 other tax deductions that most people never heard of that are also applicable to a PPP, which I want to cover in part 2. The first one is that because pension laws are governed by a different provision of the Income Tax Act than RSPs, all of the investment management fees are tax deductible within the PPP for the corporation that's sponsoring it. So in this case, we've looked at this doctor's investment account in the PPP from the year 2020 until retirement 20 years later at 2040. We can see that with the 5% growth and the contributions, the account just gets bigger. We've assessed arbitrarily a 1% investment management fee on the assets. Of course, that could be lower, that could be higher, but just for ease of calculation, a simple 1% calculation. And then remember that I told you his medicine professional corporation is paying tax at 15%. So we've derived from the savings or the tax write-off what the taxes saved by the corporation would look like. And we tallied them up over the period, and you end up with a credit of $47,882. Of course, that number could be higher if the fees paid were higher. Now, $487,000, that's monies that doesn't have to go to CRA anymore, that gets kept in the corporate bank account because of the tax deductibility of the fees. So it's an important number because the fee deductibility is important because while Integris charges fees to administer this plan over that 20-year period, and our fees is, in this case, would be $48,600. That's the highest possible fee. There are cheaper alternatives. But $48,600 minus the credit means that really the true economic cost of running this program over the 20-year period is $718. And if you divide that by 20 years, you pay almost $45 a year in order to have this PPP. So what exactly does $45 a year buy you? Well, it buys you an extra $779,000 in retirement. But that's not the end of the story, because in addition to fee deductibility, we have another very large corporate tax deduction called terminal funding that also kicks in. Now, terminal funding is a term of art from pension jargon, and it is an amount of money that a corporation would be depositing inside the pension plan in order for the client to start drawing on their pension sooner than the normal retirement age. So let's assume in this case that this doctor wanted to turn income at age 62 instead of waiting to age 65. Now, if you look at this table, on the right, on the left-hand side, we have a column in white called the basic pension, and next to it, to its left, is the retirement ages that are possible. So if you look at age 65 in the year 2040, you can see that the pension plan promises an annual pension of 175,540. But let's say this doctor said, I don't want to wait till 65. I'd like to start collecting my pension sooner. Let me start at age 62. So at age 62, you're not eligible for $175,000 a year. You're only eligible for $123,000 a year. So this is where you can see that there's an actuarial reduction in the size of the pension paid by the pension plan. However, the nice thing about the pension plan is that if the Medical Professional Corporation were to contribute $575,000 as terminal funding, this is a full corporate tax deduction. This is taken off of pre-tax dollars. Then what happens is that at age 62, instead of collecting a $123,000 basic pension, this doctor will be taking home, well, not taking home, but will be paid $169,000 a year from the pension plan, because we've given the pension plan $500,000 more so it can afford to pay an enhanced pension. What we've done is we've taken the basic pension and we've layered on an additional pension and a temporary pension to the basic pension amount. So we've increased the standard of living of the doctor. It's almost what he would have earned had he retired at age 65. It's a few $1,000s less, but he doesn't have to wait those years. He's collecting all these extra years of pension, and we've given his company a massive tax write-off. Now, 169,476, keep that number in mind because it's going to show up in the third advantage that we're going to cover in this video. And the last one is called pension income splitting. So under pension income splitting, we are allowed to take half of the pension that is payable to the plan member and move that to the tax return of the spouse, forcing the spouse to declare it and to pay tax on it, but also reducing our client's taxable income by half. So let's go through a quick example. This is the annual pension that this doctor is collecting at age 62. Now in Ontario, and it's similar across the country, if we don't do income splitting, the tax would be about $55,000. But because it's a true pension plan, and because now we're allowed to split that 50-50 with a spouse on the spouse's tax return, what happens is that each person is paying their portion of the pension at their new tax bracket, and so the couple ends up paying $36,400 instead of the plan member or paying $54,000. So what we've done in effect is we've given this couple over $18,000 in tax savings every single year that we're doing this. And I've got a little banner at the bottom saying this is not bad, given that the cost of the PPP, worst case scenario, the most expensive version is $2,800 a year. So you can see that just by doing that, we've covered the cost a number of times annually. Not that the cost of the plan is $2,800 in real terms. Remember, with the fee deductibility, we were able to reduce that to $45 a year. So this is where the economics comes in. So what have we done? Well, first of all, we've made the client substantially wealthier in retirement than had he relied on the RSP system, because he now has over $750,000 more to retire on for no extra market risk. The company that he owns has also saved substantially more tax because we've given the company almost $500,000 in extra tax savings. And the couple, because after all, we're doing this for human beings, not for corporations. The couple who's going to be receiving this pension, thanks to the pension income splitting, is saving over $18,000 annually off their tax bill. And because of the other tax deductions that the PPP offers, the cost of the program is borne entirely by tax refunds or savings. It's not coming out of the client's spending account. It's really the taxpayers of Canada, by not collecting as much tax, are subsidizing the cost of running this program. But if that wasn't enough, we've also provided this client the highest level of creditor protection in Canada, because this is a registered pension plan, and superior investment options, because we're now restricted to RRSP eligible asset classes. We can mimic what the most sophisticated institutional pension plans in the country are doing when they're investing for their plan members. And we've provided an extra layer of protection through the use of the integrous pension lawyers through what we call fiduciary oversight, which you do not find in Canada with people who have individual pension plans. So that's really the value proposition in one slide. I got a couple of extra slides just to say that as a variation on a theme for those who like to use segregated funds, we now have the option through two carriers to invest the assets with a contractual guarantee offered by the insurance company, so that even if the market were to take a beating on a death of a plan member, the insurance company would have to cough up the extra money to make sure that the guaranteed value is maintained inside the policy. So we have extra ways of further protecting the client for those who like this type of investing. And so just to wrap up sort of my time in discussing this before we take questions, again, I go back to the three fundamental questions. Do I want to pay less tax than 98% of Canadians are using RRSPs to save for retirement? Do I want to upgrade from the RRSP world to the pension world? Do I want to maximize my retirement income? Do I want to be at the top of that graph that I showed you for the same level of risk? And do I want the tax refunds to pay for this instead of me having to shell it out of my pocket? If you've answered yes to all these questions, then I think you're primed for a PPP discussion. So with that, I will pass it back to the hosts and field some questions. Thank you.
Thanks very much, JP. That was fantastic. And I mean, I think everybody watching this can see why strategy for a lot of those incorporated professionals in particular, or incorporated business owners, and in terms of providing them with more flexibility about their retirement options. It almost seems too good to be true. And I think, you know, the first question I just wanted to ask you is, you know, like, what do you say to people that say, hey, this seems too good to be true?
Yeah, well, you know, I say a lot of things to these people. One of them is, well, what do you think of permanent life insurance and universal life policies and all those types of tax-free ways of getting money out of your company? To me, that's even better than a personal pension plan in many ways. How come nobody's going after that? So there are other solutions in the marketplace besides the PPP that I would argue are even more powerful. So it's not too good to be true, but it is indeed I would say an ingenious use of existing legislation to maximize retirement savings. And in that sense, it does come across as a very powerful solution. So yes, it has the appearance of being too good to be true, but it is based in law. It's approved by the government. It's registered with the CRA and with provincial pension commissions, depending on your status as a shareholder. So it's been around for 8 years. It's approved by most of the large financial institutions in Canada. It's been vetted by their legal teams over the last 8 years. So it's the real deal.
We put together a couple questions here, JP, that we get time and time again working with clients and their accountants and whatnot to implement these solutions. The first kind of question that I wanted to bring forward is exactly how to account for the pension plan on financial statements of the business.
Sure. So the important thing to remember is that the assets inside the PPP are not assets of the business. So a lot of accountants are worried that if the company is investing passively in a pension plan, that somehow this might create a tax on passive investment, a TOPI problem, or maybe it might taint the business if it tries to be sold for triggering the lifetime capital gains exemption. The answer is that that is not the case. The assets of the pension plan are separate and apart from the assets of the company. So while the financial statements would have a footnote that mentions that the company is sponsoring a pension plan, the value that's been extracted, remember, these are tax deductible contributions for the company. The value of those assets does not reflect on the financial statements anymore. It's sitting inside of this standalone personal pension plan.
Great.
So, we compared a lot to RSPs in this presentation, which, have tax deductible contributions, obviously. So are pension contributions fully tax deductible?
Yes, they are. They are. It's a full pension expense. And when an accountant prepares the T2 return, you record them under Schedule 1 and Schedule 15 of the T2 return as an expense.
Perfect. Another common question I know we get, obviously, we're with these strategies, they're being implemented with a lot of family-owned businesses or even just professional businesses. What happens to the pension if the owners of the business decide to sell the business?
Okay, so there are multiple options that are available to our clients when there's a sale of a business. So first of all, a sale of business could be either a share deal or an asset deal. If it's an asset deal, meaning that the shareholders continue to control the corporation, it's just the company selling its assets in exchange for cash, nothing happens because there's no change of ownership. The pension plan stays within the corporation. It's just that now there's all kinds of cash that's come in because the company has sold assets, which actually leads us to some tax planning opportunities, because imagine a situation where a corporation has real estate as an asset. It bought a building, and of course it depreciated the value of that building over the years for tax reasons. But now it's selling the real estate at a premium. So not only do we have a capital gain, but we also have recaptured depreciation that we have to worry about at the corporate level. If we set up a PPP and we fund it, and you saw in the example of the doctor, there was a $500,000 terminal funding opportunity. Well, if the purchaser brings a check for $500,000, that money can be used to fund the pension plan, creating an offsetting deduction within the corporation to mitigate the recaptured depreciation and the capital gains. So that's one opportunity. Now, the more complicated case is when we do a share deal, when new shareholders show up with money in order to become the new owners of the company. And obviously the new owners don't want to have anything to do with this PPP that the seller had put in place for himself or herself. So what are the options? Well, one option is that the seller, the selling shareholder, could always incorporate a new company and assign the pension plan from the company being sold to the new company, to NewCo. And that's done through what we call an assignment and assumption agreement. It's an agreement between the two companies that the pension responsibilities and the assets, the bag of money is moving from company A being sold to company B, the new company. So that cleanses the company from the pension plan, and the new shareholder doesn't have to worry about it.
Mhm.
That's one option. Another option, if you can't do that, is you can always wind up the pension plan and transfer all the money out to a locked-in retirement account, or buy an annuity with it, and just disperse the assets into other financial products as permitted by pension legislation. So the shareholder still has the money. It's just no longer in a pension plan. It's in a locked-in account or locked-in RSP, or depending on your province. Some provinces, it could be just an RSP or a RIF. So it depends on your status as a shareholder. So there are multiple ways of dealing with it. Now, sometimes business owners will have an operating company and a holding company. So we could have Holdco sponsor the PPP and OpCo as a participating employer, participating in paying the salaries and making the contributions to the PPP. Now, if Holdco sells to a third party OpCo shares, then OpCo ceases to participate in the plan. The connection between OpCo and the PPP is severed, and Holdco, which is sponsoring the plan, would just continue on with sponsoring the plan. So there are many different configurations, but in no case does this pose a problem for the shareholder.
Now, we see a lot of value in this plan, and especially in within family businesses or transition of wealth between families. So, I wonder if you could just talk briefly about that, and also what happens on the death of a plan member.
Sure. So let me start with your first point, which is really in a family context. And before I even get into that, let's step back and look at the state of the law. What does the law says with RRSPs or RIFs? If you don't have a spouse and you die, we have what's called a deemed disposition under the Income Tax Act. You're deemed to have disposed of all of the assets inside of the account, and you got to pay tax on it. Well, the estate has to pay tax on it, which is really very expensive. If you have a spouse, there are spousal rollover rules, so that tax is deferred, and then the tax will only occur on the second death. When the spouse dies, then we have the deemed disposition problem to worry about, which is problematic when you have a car accident and mom and dad are sitting in the car. So the question is, can the PPP help with such a rule when we're dealing with a family enterprise? And the answer is yes. So when we're dealing with a family business and the kids, and when I say kids, I mean they're adult, but they could be children, but adult children usually are on the payroll because they're working in the family business, then we can make the children members of a family pension plan. And that means that when mom and dad start drawing their pension, let's say they do terminal funding and they start retiring at 60, they start collecting their $169,000 a year pension, like in the example here. When they pass away, instead of having a deemed disposition, all the money, all the capital that had been stashed away inside the plan to pay that pension, and when you looked at the illustration, we were looking at over $3 million, all of that money now becomes pension surplus. It's trapped inside the pension plan, which means it doesn't get taxed and it doesn't get subjected to probate. But the kids are plan members. So now that surplus is theirs. It doesn't get paid to them out of the plan. It's just sitting there available for them to use as they see fit. So what we have is an intergenerational transfer of wealth without the deemed disposition. And this could mean millions of dollars in taxes saved or deferred further for the children that are working in the family business. It's like buying life insurance without having to pay for the premiums, which is a nice feature. So that's, in the context of a family business, this is probably the most powerful element of the PPP, is this ability to transfer potentially millions of dollars to the children without having half of it or a percentage of it taxed on death. Now, the other question was, well, what happens when you die? So, of course, what if you don't have children in the business that are on the payroll? What happens then? Let's say you're just a lawyer that has a legal professional corporation, and you don't have any kids. So under pension law, there are two different types of deaths. We have what's called pre-retirement death, which has its own set of rules, and post-retirement death, when you're collecting your pension. So in a pre-retirement death, during the accumulation phase, the law says that whatever is sitting in the pension plan transfers over tax-free, tax-deferred to your spouse, if you have a spouse. So it's no different than an RSP. But what happens if you don't have a spouse? Then the money is paid to your designated beneficiaries and set the percentage that each child or each beneficiary will receive when you sign up. And then whatever is in the plan gets split amongst them, and then those amounts are taxable in the hands of the beneficiaries. So if you have a lot of beneficiaries, you could be doing some income splitting there. You can also designate a registered charity as a beneficiary. In that case, there'll never be any tax, because pre-tax dollars came in from the company, never got taxed in the plan, and now they're sitting in the bank account of a registered charity, which also doesn't pay tax. So that's another option. Now, if you don't have any beneficiaries, you forgot to designate someone, the money drops into your estate, and then it gets taxed under the normal rules. So that's the pre-retirement death situation. In a post-retirement death, the assumption is that the pension plan is paying you your annual or monthly pension. Again, if you have a spouse, that pension you are receiving now carries on to your spouse for the rest of the spouse's life. The question we get all the time is, well, what if both die? What if you die with your spouse while you're retired? Well, that's where all the money becomes surplus. And we talked about surplus before. What happens is it just sits inside the plan. And if you have children that are part of the plan, they get it. But if you don't, then there are other options. So one option is that the company, as the administrator of the plan, could say, wow, we've got $10 million of surplus. We're going to make a distribution of that surplus to the beneficiaries. So then everybody gets their chunk. They have to pay tax on their piece, and the plan is dissolved. Or the company could do what's called a surplus reversion application. It could apply to get that surplus back into corporate coffers. That's another option. And that would be taxable to the company as investment income. However, maybe the company has tax losses that they've carried forward that they haven't used up in the past. So those losses could negate the taxes from the surplus. So the company ends up with the cash without having to pay tax on it. That's a possibility. So many different things can happen to surplus. But anyway, that's the answer. The answer is complicated as everything pension related, but there's a system, or there's some logic to it.
We briefly on the selling of a business and what that does to the pension plan, which then brings up, I guess, another question that we get quite often from accountants, and it has to do with the use of the pension plan and the passive assets. Do these at all threaten the lifetime capital gains exemption?
Yeah, so the answer is no. In fact, we help purify a business to make it a qualified small business corporation in order for the shareholder to enjoy the lifetime capital gains exemption. Not only do we purify, but we also give the company a tax write-off. So it's much, much more efficient to purify a business using a PPP than just to do an intercorporate dividend up to a holdco. Because all we've done there is, first of all, we didn't get a write-off because a dividend implies you pay tax. And then holdco now is passive income, corporate passive income, which is taxed at a punitive rate. And you got to get it out of there somewhere. So if holdco owns other operating businesses, under the tax on passive investment associated rules, all that passive income will now grind away at the $500,000 small business allowance for those other existing holdco opcos, and chip away and make it tax at a higher rate. You lose the 12.5%, or depending on your province, 11% in some, and you jump to 26%.
I just have one last question for you, actually. So this is obviously, it's a great strategy in a lot of different situations. Is it ever too early or is it ever too late to look at a PPP if you have a corporation?
Yeah, it could be too late if you're 70, because 71 is the last year in which you can join a PPP. But for administrative reasons, because there's so much paperwork and effort to put it in place, our actual team wants us to only take people that are 70 years old or younger. So if people wait too long, then they're going to lose all of these benefits. So there is a necessity to focus on this stuff before age 70. There's no too young, because we have a client that's 16 years of age that's a plan member. And the reason why a 16-year-old has part of a PPP is because it's a family business and he's on the payroll along with his father and his grandfather. So when grandfather passes away, father and son will get the surplus. And when father passes away, the son will get everybody's money. And you'll never have to worry about saving a penny for retirement. So there's no early, I mean, of course, you don't want to have child labor, but there's no real limit to the early age. There is a finality to age 71 or age 70.
But anytime before 70, it's worth taking a look at.
Oh, yeah. Especially if you've paid yourself salaries out of your business, because you might have a massive buyback of past service. We had a $52,000 example. I've seen it go up to $450,000.
Wow.
For people who have had a lot of salaries.
Wow.
So yeah, no comparison to the RRSP. Unfortunately, Canadians, now RRSP season is going to start, and you're going to go on LinkedIn and Facebook, and it's going to be, should you do an RRSP or a TFSA? It's this puerile debate. It's like, no, guys, you got to do a PPP.
Well, that's why we're doing this. Brent, I don't know if you have any last questions.
No more questions for me.
Okay, we'll close it off there, JP. Well, thank you again so much for sharing this information with us and our guests. As everybody can see who's watching this, this can be a very powerful tool. And the one thing that we would say is that we never disqualify yourself or never disqualify your clients if you're somebody that works with professionals or incorporated people. Let us try to qualify them and take a look at the situation and see if it makes sense for them. And we'd be happy to look at any of those situations. So feel free to reach out to either Brant or myself at Endeavor Wealth. You can visit our website at www.endeavorwealth.ca. Or you can give us an email at grant.white@endeavorwealth.ca or brant.butt@endeavorwealth.ca. Thanks very much. Really appreciate your time. Have a great day.